Welcome to the Crypto Craze. I'm Tanea McKeel.
And I'm Brad Smith. Thanks so much for joining us here today.
Let's kick things off the way we always do. Let's check in with Bitcoin and Ether. And let's start with Bitcoin. Down this week, it has taken a nosedive over the last week, dropping below $7,900 compared to a price of about $10,000 last week. This 20% plus drop has left much of the Bitcoin community confused as seemingly positive macro industry events took place, including the launch of Bakkt's Bitcoin futures market. Large transaction average for the last 7 days, $10.3 billion a day, representing an 18% increase compared to a 2019 average of $8.7 billion a day. The recent increase in large transactions is in line with the historical trend of increased large transactions during periods of high volatility.
A similar story here as well with Ethereum. Ether's price is down below $160 today, representing a 25% decrease versus last week's price of $213. And large transaction average for the last 7 days, that's at $236 million a day, representing a 4% decrease versus 2019's average of $245 million a day. While the average over the last week is lower than the 2019 annual average, the last few days have seen very high, large transaction activity due to Ether's price volatility.
So what happened? Why did the market sell off? One leading theory to explain the price drop was the sudden flash crash witnessed in Bitcoin's hash rate during the week. Put simply, hash rate is a general measure of the processing power of the Bitcoin network. So the higher the hash rate, the more computing power that is needed to add blocks to the Bitcoin blockchain. This effectively increases the security of the Bitcoin blockchain because it makes it harder for any one group to gain control of the majority of the entire network's processing power.
And on September 22nd, Bitcoin's hash rate that crashed by about 30%. This flash crash likely spooked market participants who feared that the decreased processing power could cripple the Bitcoin blockchain's throughput and potentially make it more vulnerable to a cyber attack. The reason for the sudden drop in the network's hash rate is still unexplained and likely led to a sell-off in the price of Bitcoin. Since most of the crypto market is correlated to Bitcoin's price, we saw a similar but even more pronounced sell-off in Ether. And now let's take a look at how this sell-off impacted market participants. One more key metric that we've been keeping an eye on is in and out of the money. It analyzes which average price position of current holdings for all of Bitcoin and Ethereum wallet holders and addresses those that have an average price below the current market price. And those are categorized as in the money because they would realize a profit if they were to sell today. The opposite is true for the out of the money addresses. Their average prices are above the current price and would therefore realize a loss if they sold today.
As of this morning, about 67% of Bitcoin addresses are in the money. Bitcoin's weekly price decline has reduced the percent of addresses that are in the money by about 9%. That's compared to last week.
And additionally, this morning, about 15% of Ethereum addresses are in the money. Ethereum's weekly price decline has reduced the percentage of addresses that are in the money by about 14% compared to last week.